Did you know you can have a perfect credit score without being a millionaire, without spending any money, and without owning anything fancy? Because the credit system is just a game, and once you know the rules, you can hack it to perfection to get a high score. Today, I'm going to tell you about the process to get that perfect 800 to 850 credit score, why it matters, and how you can make thousands of dollars in that process. And unlike those get rich quick finance bro dropshipping guru kind of videos you see out there, this doesn't cost you a dime. Look, I've personally saved probably about $500,000 in my lifetime on property mortgages by having a credit score that lets me get a lower interest rate. But you don't need to be a real estate investor to see these types of benefits. If you have a car loan, if you have credit cards, if you ever want to borrow money for education or investing in your business or investing in your retirement, having a credit score that lets you get a lower interest rate or lets you sign up for premium credit cards or borrow a line of credit will have a significant financial impact on your life. So grab your credit report and let's see how this system actually works. If you've ever tried to learn about personal finance on YouTube, you've probably heard gems like wake up at 3 a.m. with a millionaire mindset, or your network is your net worth, buy my course on dropshipping, or this dog coin is going to the moon. It's all absolute rubbish. And here's why. Real financial experts, you know, the boring ones with actual qualifications, agree that for 90% of people, there are four core financial pillars that they need to start with before they can think about doing anything else to build their wealth successfully. Pay off your debt, especially any high interest debt first, because compound interest is only fun when it's working for you, not billing you. Make a sustainable budget with a savings category. And yes, Uber Eats counts as a luxury item. Start investing early, even if it's just $10 a month. And lastly, raise your credit score. That last one is one of the most important and yet one of the most misunderstood and overlooked when it comes to personal finance. And that's why it's important that we talk about it today. You can think of your credit score as a financial report card, but instead of measuring how good you did at math or English, it measures how well you handle your money when it comes to credit. A credit score ranges from 350 all the way up to 850, and anything above an 800 is considered a perfect score. And just like in school, no one's really impressed with a C average. But here's why you should care. A perfect credit score isn't just about bragging rights. There's real tangible benefit. Let me talk about some real numbers here. Let's imagine you have a $400,000 mortgage. In scenario A, you have a good credit score of 670. Maybe your interest rate is going to be about 6.5. That's a monthly payment of $2,528 and a total paid over 30 years of $910,080. Now let's imagine that same scenario where somebody has an excellent or perfect credit score. They might get an interest rate of 5% on that mortgage, meaning their monthly payment is $2,147. Their total paid over 30 years is $772,920. That's the difference of $137,160 in a single mortgage. Now, if you were a real estate investor and you multiply that across multiple properties in your lifetime, that really starts to add up. But even if you don't, even if you have two car loans or you want to get a loan for your kids to go to college, if you want a personal line of credit because you want to buy a stock market dip in your retirement account, having lower interest rates will make all the difference. The credit score can also make a difference between whether a loan gets approved or not in the first place, or whether you're eligible for credit cards that have the best perks and sign-up bonuses. Hell, these days a credit score can actually impact your insurance premiums, and in certain high-risk industries, whether you're eligible for a job or not. So let's talk about the 6 factors that really make up your credit score, how easy they are to perfect once you understand them, and the specific tips that you can use to start raising that credit score. First up, at 30% of your overall score is that payment history. This seems like an obvious one, pay on time. But this doesn't mean pay your bill in advance. This doesn't mean pay it off. This doesn't mean make sure you pay that month. This means pay the minimum payment on the exact day that the minimum payment is due. Miss one payment by 30 days, your credit score drops 100 points. Miss a payment by 90 days, you may as well set your credit score on fire for the next year or two. Dealing with your payment history is as simple as setting up automatic payments. Have automatic payments for everything: your membership fee, your average balance. Do not fully pay off the card, but make sure your automated payments are hitting that monthly minimum balance every single month on the exact due date. Now, that one was a no-brainer. Even your grandmother knows make those payments on time. But the next one is a little more complicated. It's your credit utilization. Utilization is just a fancy word for what percent of our available credit are we actually using on a regular basis. You don't want your credit utilization to be too low or too high. We want it to fall into a Goldilocks zone, because having a zero balance on your credit weirdly is a bad thing. But having too much credit utilization, that's even worse. So, what's the magic number? At all times, you want your credit utilization to be somewhere between 1 and 3% of your available credit, never paying off more than that. If you're using your credit above that, you should pay that down quickly and try and always maintain that balance, making your minimum payments on a regular basis and keeping that credit open. So, how do you improve that credit utilization? One mistake people make is they get one low limit credit card and try and live off that. They don't understand why their credit rating isn't going up. If you on average spend 20 to 30% of that card's available utilization, your overall utilization looks high, even though your balance is low. This is why a lot of wealthy people have multiple credit cards, including credit cards that they don't use. I have a credit card that is just my Netflix account. I have it bill my Netflix, I have it auto pay. That's all that's on there on a regular basis, completely getting paid off. And it has a high limit. The only reason that credit card exists in my name is so that I have a higher total amount of credit so that my utilization is lower, even if I'm carrying a balance. Now, this can be risky. If you're not the type of person who's going to regularly pay off cards or is going to use the overall limit that you have available, don't do this. But if you can manage your automatic payments, if you are the type of person who can be responsible with a higher limit balance, then raising your overall limit and not using any of it so that your utilization is always low is going to dramatically help your credit score. Number 3 is the length of your credit history, but the average non-total length of your credit history across each credit line that you have. This sounds like where the young people should start groaning, but they're actually at an advantage. Opening up your first credit card as early as possible and never canceling it is going to help you raise that overall average when you open up larger lines of credit later on. Every time you open a new credit card, your average age of your total credit drops. It's like having a 30-year-old and a newborn. Their average age is 15. So here's the strategy. Start early. Even if it's just a secured credit card that you can get as a teenager, have it. Open it up, a minimum balance, pay it automatically, and never close it. Even if you hate the bank, even if the rewards are rubbish, even if that is the most useless credit card you ever have, just keep it open. And if you're young and in a good financial position, you want to be able to open up a multitude of credit lines, whether that's a personal loan or a mortgage or a car loan or a couple of credit cards, spacing those out about once every 6 months, but doing them earlier in your life to start building that track record. That doesn't mean you should use these lines of credit. That doesn't mean you should rack up debt or be irresponsible with them, but it does mean you want to open them earlier and plan ahead. And here's a really sneaky trick for this one. Become authorized as a co-signer on your parents' 20-year-old credit card. As long as they've got a good credit history and no financial sins of their own, that now factors in at a diluted rate, but factors in to the average age length of your credit lines. Number 4 is total credit lines. And this is where it starts to get stupid. What you have to remember is that credit scores aren't an accurate reflection of your ability to manage this debt. Credit scores are designed by credit rating agencies and credit card companies to score and reward who is best for them as a business in giving out credit. That means they want you to have as much credit as possible. That's why having a zero balance or closing out an old card is considered a bad thing against your score. They make you play their game. The credit scoring system actually rewards you for having more total available lines of credit. It's like giving an alcoholic the keys to the brewery and saying, show us how responsible you are. And I'm not joking, because the average person who has a perfect credit score has somewhere between 15 and 22 total lines of credit across personal, business, and other types of loans and cards. Now, that doesn't mean you should rush out and open 22 credit cards. That's not going to be a good idea. And you don't need that many lines of credit to achieve a perfect credit score, but having multiple ones will help. So how do you play that game in a smart way? As we said with the credit cards, opening up 2 to 3 credit cards, waiting 6 months between those applications, mixing different types of account. If you've got 2 to 3 credit cards, your next type of credit line should be an auto loan or a secured line of credit, something like that. And never close those oldest accounts. And as you start to build up these credit cards and these lines of credit, that will add to the overall credit score. But remember, this only works if you are treating these credit cards as a scoring method, a game to get a better credit score. They are not free money. They are not money you should expect to use. They are not money you have. If you are buying things across all of these credit cards, you cannot afford them. If you cannot trust yourself with those credit cards, ignore everything I've said and just stick to a debit card. Because putting on that high interest rate debt and lowering your credit score would be far worse than trying to raise it by even a few points. Number 5 is credit mix. Because apparently having a bunch of credit cards isn't enough, they want you to have all the flavors of debt. Credit cards, mortgages, car loans, personal lines of credit, maybe even a store card. Yeah, it's ridiculous, but the system actually wants you to take out money to prove it how good you are with money. So what's the hack for this one? Sometimes it's worth it to take a small loan even if you don't need it. Let's say you're buying a car, maybe even a used car that you could buy in cash. If you've got a good credit rating, if you've got a good relationship with your bank, maybe you can afford to finance it at a low percent. Especially if rates start to come back down again, maybe you're looking at these 2, 3, 4% rates. So putting a portion of that car's value onto a low interest loan, keeping the cash aside, ideally in an overnight yield bearing account, and paying off the minimums and paying up to your maximum monthly payment on that to pay it down quickly is probably going to benefit you more than buying the car outright in cash, especially because cars aren't a great book asset and depreciate so quickly. It's rare that I ever recommend financing something rather than buying it outright, but if you're trying to purposefully raise your credit score, this is one of the rare times where that can work. And the final component we need to talk about is hard queries or hard pulls against your credit score. This is like getting penalty points on your driver's license. Every time you want a new line of credit, every time you want to buy something, an inquiry will be made against your credit score. These hard inquiries are where stores or financial institutions check with the credit bureau what your credit score is. Each inquiry will drop your score by 5 to 10 points and stays on your credit history for about 2 years, which is why you want to space out applications, but not too much. However, all credit applications for the same type of loan within a 14 to 45 day window, depending on the type, count as one single query. So if you're shopping for a mortgage, you want to get as many quotes as you can within that small window. So how do we deal with this one? Space out your applications by 6 months, especially if it's something like a credit card. If you're shopping around for a specific type of loan, bundle all those inquiries together and try not to spread those out at all. Never randomly apply for something that you don't need because it will ding your score and be there for at least 2 years as an anchor. And if you've opened up multiple credit cards with multiple institutions and are paying them off on a regular basis, wait until they give you a pre-approved offer for a credit limit raise rather than applying for one yourself. Often after 6 to 12 months of using a credit card on a regular basis, even just for a Netflix payment, a company is willing to offer you a pre-approved increase in your limit and doesn't do the same kind of hard pull for something that's pre-approved. And how do you implement and monitor all this? Let's put it together in a bit of a practical strategy. Step 1, if you're in the US, get your free annual credit report from each credit bureau. They are required by law to give you one free report each year. That doesn't count as a hard pull against your credit score. Sign up for free services like Credit Karma or Credit Sesame. They attempt to calculate your credit score based on publicly available information. So it's not the exact credit score that you have with any of the major credit bureaus, but a rough estimation that updates weekly. This doesn't result in a hard credit pull and lets you gauge throughout the year how your credit is developing. Now, these companies monetize by spamming you with credit card and mortgage offers, and while they look great, they are usually not the most efficient ones. So you should just ignore all of those and get the free data. Then set up a 12-month plan. Month 1 and 2, set up automatic payments on all of your accounts. Make sure they are aligned with the payment date and paying at least the minimum balance, and make sure they're never fully paying off the card. Remember, you want to keep in that 1 to 3% range. Month 3, apply for a new credit card if you need one. Shop around a little bit for one that's got a points program or a cashback program that's complementary to where you're spending most of your money. And since you should probably already have a budget, that should be easy for you to tell. Month 4 and 5, continue to just make these regular payments and look at getting added as an authorized user on good accounts with any of your relationships, whether that's your partner or your parents, cards that you're not going to use but that you can inherit the good credit history of, if they'll let you. Not everybody has that option. This isn't something that I used because I didn't find out about it till much later on, but it's a great opportunity if you have it there to give that credit score a boost. Month 6, if your credit utilization is high across all your cards because they are all low limits and no one's given you a pre-approved limit, this might be the time that you want to start exploring actually applying for a credit limit raise, as it's been a few months since our last application. Months 7 through 11, continue to just pay everything on a regular basis, target that low utilization, and check in on our automated payments. Make sure we're not missing anything, make sure interest rates haven't changed, minimum fees haven't changed, and that things are still moving along. Month 12, you're at the end of the year, you should be ready to get another free credit report from each of those credit bureaus. Get your full report, look through anything they've dinged you on, look through what's added to your score, understand what's working, and adjust your strategy from there. Those are all the things that we do to increase our credit score and to try and raise it up to that 800, 850 bracket. But there are also a number of mistakes and red flags that people make that lower their credit score and work against them. So let's quickly highlight a few of those. In our credit score hall of shame, we have closing old credit cards. Why? Why are you doing this? I know you don't want those paper statements. Switch to electronic statements, ignore that card, forget it exists, and maintain a zero balance on it. Maxing out your credit card rewards just for the points. There are very few cases where those points are worth it. especially nowadays. There's too many points guys, there's too many point hackers, and you're probably not on the ball enough for this to matter. The reason the credit cards shell out points so quickly is because they're also happy to turn around and ding you 26 to 30% interest on payments that you miss. Don't chase points. Playing balance transfer roulette. If you've got credit cards that have a high balance and you're just moving them between different credit cards, trying to avoid late penalties or interest fees, you're actually probably paying a large cash advance fee as you move the money, and this is going to be reflected negatively in your credit score. If you have high interest credit card debt that you cannot pay off and is too large, talk to a bank about a low interest line of credit, usually a secured line of credit or a secured personal loan. These are not going to hit your credit score in as aggressive of a way, but they also often have a much lower interest rate. You can then consolidate your credit card debt into that low interest loan, keeping the cards low and avoiding using the cards and racking up that debt again. Co-signing loans for unreliable people or authorizing people on your card who aren't reliable. Don't do it. They miss a payment, you're screwed. And my personal favorite, paying someone to fix your credit. They can't do it. Don't pay for weird credit services. Don't pay people to fix your credit. Understand how your credit score works. Pay the balances. Have some utilization, be responsible. Your credit score will go up over time. Here's the truth. Credit scores don't have quick fixes. Building perfect credit takes time. On average, if you have a credit score that's 650, 700, 750, this is a 2-year journey you're talking about. And if you have a credit score that's bad, it's a 2-year journey for you to repair it. But it's okay, you can do it because it's easy and you just have to be consistent. You don't need to spend money. You don't need to have lavish assets or be a millionaire. Just be consistent and you will get there. So there you have it. The complete blueprint to getting a perfect credit score. No guru nonsense, no get rich quick schemes, no 1-800 debt hotlines, no pay to fix. Just proven strategies that actually work based on the way that we score credit. And the reality is that most of building wealth is like this. It's understanding the financial game, the way it works, and playing the game consistently. The best financial advice isn't always flashy. It isn't some secret formula or hack. But methods like this will save you tens of thousands or hundreds of thousands of dollars over your lifetime. Money you can put in the bank for retirement. And the biggest difference between those who will retire on a beach and those who will work till they drop dead is just whether they took the time to understand these boring concepts or not. If you found this helpful, go ahead, smash that like button, subscribe, drop a comment, help me escape YouTube algorithm hell, and let me know what other personal finance or investing topics you want to see covered and like to learn more about. Until then, stay safe, stay savvy, and just keep learning.